As fears mount over the economy that the economy might be heading towards stagflation, our next guest says that the current economic scenario is nothing like the stagflationary environment of the late 1970s. For more on the markets ahead of the busy week that we've got this week with earnings and the Fed's policy meeting, we want to bring in Ed Yardeni. He is the president of Yardeni Research. And Ed, this idea that it's not going to be just like the 1970s stagflation is a pretty good one on a Monday morning. Makes us feel better about this being a Monday. Explain.
Yeah, I want you to feel better. Look, I think last week when we got the GDP report, the knee-jerk reaction was that the data was stagflationary because real GDP was up only 1.6%. But a lot of that was because we imported more and we also saw less inventory accumulation. The final demand in the economy was still actually very, very strong. In addition, there was concerns about the pickup in inflation during the first quarter. I think some of it was kind of funky January, February effects. But we still do have a problem with the so-called super core inflation rate, which is the consumption deflator for services, excluding energy and excluding shelter. That's kind of stuck around 3.5% recently. But I think that's going to come down. One of the problems we have on the inflation side really is auto-related insurance and repairs have been a real problem on the inflation side. I don't know that there's much the Fed can do to repair your car or to offer you auto insurance, but that's bound to slow down. It's just been on fire for so long. So all in all, the economy is still doing well. On a year-over-year basis, we're still seeing a moderating trend in inflation. So I don't think this is stagflation at all.
You also don't think that the markets are going to continue to melt up, though, and that from your perspective, is a good thing, the idea that we may pause for a while here.
Yeah, just because I would like that doesn't mean it's going to happen. But I actually was concerned that the market was going up too fast and that it was being led by the valuation multiple. And we got the forward PE and the S&P 500 up to 21. Now we're back down to about 20. So it hasn't been that much of a correction in the PE. But I wouldn't mind if the PE just kind of stayed here for a while. And it turns out to be an earnings-led bull market from here on. I think for now we could very well just pause. The market still, I think there's expectations for two rate cuts still in the market. And I think we need to be disabused of that notion because I don't think there are going to be any rate cuts this year. But, the market's also looking a year ahead, and a year ahead, sometime into next year, there could be a couple of rate cuts.
What surprises me is you've got a pretty strong forecast. Even though you're talking about a pause here, you've got a strong forecast for where the S&P will be for the end of this year,
yes.
Not to mention where it's going in 2025 and 2026. You want to lay that out? In fact, let's bring back up the S&P 500. Right. You can see how far we've come since November. Yeah,
it's been extraordinary. And look, it's been my opinion since November of 2022 that it's been a while here that we're in a bull market. The bull market had a nice run from that point through, last year, last August, and now we saw a correction there for a little while. Then we made a low on October 27th of last year, and it was a vertical ascent almost in the market. It was feeling like a melt-up scenario, and I think it's just going to be a pause for a little while. But I still think that the underlying earnings story is a solid one. I think the valuation multiple is a bit high, but I think earnings can lead this market up to 5,400 by the end of this year for the S&P 500, 6,000 next year, and 6,500 by 2026. The 25 and 26 forecasts are not really all that bold when you kind of look at the percent changes, but they sound pretty good.
Yeah, they sound pretty good, and I guess you're calling for a pause, not a pullback. Would a big pullback
Correct.
surprise you?
Well, I mean, we have had a pullback, really. I guess from the peak on March 28th, we saw the market come down below its 50-day moving average. It was down 5.5%. I was thinking we could get a 5 to 10% kind of correction, not an official correction of 10% or more. And I think we may very well have seen it. But I think from here on, there's still the geopolitical uncertainties. I know the market's suddenly acting as though, all is well in the Middle East and between Russia and Ukraine. Well, we know it's not. Maybe what the market figures out is that even if these situations continue to deteriorate, As long as the supply of oil isn't affected coming out of the Straits of Hormuz, that there's plenty of oil available even in a geopolitical crisis situation.